So I would like to, as a current policymaker and one of the leading global thinkers of our times, I would like to bring Tharman in and ask him whether he would agree with Olivier in the sense that inequality might be better addressed by situating monetary policy within a coordinated policy effort, including fiscal policy. Tharman, can we get your views on this?
Sure, thank you. Thanks. And I'm glad I'm speaking after three excellent presentations. The short answer is yes, I agree with Olivier, but I must first say that I was a little dismayed that Olivier followed his mandate so dutifully, because my experience with all good seminars is that just like central banks, the mandate given to speakers has no predictive power as to what they're actually going to say. So allow me to revert to the mean. I think I'd like to start by taking a slightly different tack, not inconsistent with what's been said, but a slightly different tack, and ask ourselves contextually, what type of inequality are we most concerned about, particularly at this juncture of history? Because the types of inequality we're most concerned about actually differ, and the potential role of monetary policy also differs very much depending on what we're talking about, what type of inequality. In some instances, monetary policy may be part of the solution. In other instances, it may either be relevant or it may even be part of the problem. And we then have to ask ourselves, well, if in fact the problems are so severe in relation to the important inequalities of the time, should we be doing less of monetary policy or relying less on monetary policy, or is there some alternative form of monetary policy that would be more optimal? So very quickly, I think the key inequalities that we should be concerned about at this time, and we all know that COVID has been a particularly harsh recession. All inequalities are bad all recessions are bad for inequality, but COVID has been particularly harsh. And this time around, more than most recessions, we have a very odd phenomenon of a sharp increase in wealth inequality. I mean, wealth often gets destroyed in recessions, or that's what happened to some extent in the global financial crisis. That's what happened in the dot-com bubble burst. This time around, you've had a very strange phenomenon of wealth actually going up for significant groups of people at the top of the ladder, and we have to be concerned about that. But I would like to focus on what I think are the enduring inequalities that we should be most concerned about. First, we have to be particularly concerned about what happens to late middle-aged and older workers, who are the ones who are going to find it, who are already finding it very difficult to get re-employed. And if we just leave it to business of staying outside of employment for a considerable period of time. And we all know that will have a long tail of consequences for not just the atrophying of skills, but for future pensions, for health, for depression, and also, I would say, for politics. Monetary policy clearly plays a role there. The traditional mandate of trying to get back to full employment is still, to my mind, a central purpose, and still has to be there foremost in our minds. Fiscal policy plays a central role, has been doing this year already, both on the demand side as well as on the incentive side. I guess the furlough schemes are both demand and supply, but there's been a very strong signaling and incentive effect of fiscal policy this year. And going forward, I would argue, labor market coordination, which is neither monetary nor fiscal, but involves the role of the state, labor market coordination and not just leaving things to the market is going to be a very important part of the solution to this problem of a large group of people who are late middle age and older being able to get back into the workforce and ideally with decent jobs. Second, we have to be concerned especially about SMEs. That's the important part of the bottom leg of the K-shaped recovery. There's a very real risk of a wipeout of too large a segment of SMEs coming out of COVID, partly because of the peculiar nature of this pandemic and the lockdowns that had to be enforced. And the services sector in particular has a disproportionate presence of SMEs. This is of concern to us because SMEs also are the largest employer of lower income persons. Here too, I think monetary policy plays an important role, but it's been especially important through what you'd call, I guess, targeted monetary policy, which is these low-cost central bank liquidity schemes for banks and the like. Some of it is quasi-fiscal policy, but I just use the term targeted monetary policy. I think that's been particularly important. Again, fiscal policy has been front and center. There's been a whole range of across-the-board grants. And going forward, I think the need for greater discrimination, both on the targeted monetary policy side, as well as in fiscal policy, will be necessary to allow for some reallocation and to avoid obviously creating a whole generation of zombie firms. So that's a second type of inequality we should be concerned about. It's about large versus small, and we should be concerned about the SME sector and find the right policy mix to deal with that. The third inequality is one where monetary policy doesn't play a role at all, but is ultimately the most important slow burn inequality we're concerned about, which is inequality of opportunities. And that, I'd say, across a whole range of countries, including the most mature democracies, is really an issue that requires deep and hard thinking, some repurposing of fiscal policy, but also a repurposing of social and even residential policies. Fourth, let's not forget the fact that the biggest bottom leg of the K, when we look at things globally, is the developing world. They've been hardest hit, and the poorest countries have been the hardest hit in the COVID crisis. They don't have the fiscal space that the United States or most advanced countries have. And we have to be concerned about this, both from a growth and an equity point of view, because this is going to be a major growth opportunity. I can't think of a larger global growth opportunity than infrastructure in the developing world, or investments in infrastructure and human capital in the developing world. It's the largest growth opportunity the world has in the next decade, but it is also critical from the point of view of mitigating what is potentially a very large inequality going forward, with consequences which will obviously not just be economic. And finally, intergenerational inequality. We are facing the biggest intergenerational inequality we've ever known, which is climate change. And on the last point I was making, I should say that global monetary policy matters. Using the innovations and initiatives within the international monetary and financial system are critical for that whole issue of global inequality, and particularly making sure that the developing world doesn't submerge. Coming to climate change, it's an issue where I can't think of a meaningful role for monetary policy as such. It's all fiscal or global public goods, and we know what needs to be done. So coming back to Olivier's question, which he put very squarely, there's some inequalities which have to do with employment and wages and incomes, particularly at the lower end of the ladder, where we know that monetary policy can do something by raising the level of activity and heating up the labor market. And we also know, as he's pointed out, that there are some distributional consequences which go the other way, mainly because monetary policy is, particularly when you're at the effective lower bound, is operating largely through the asset markets. And intrinsically, we do have a wealth distribution issue coming out of the very functioning of monetary policy. So the question which Olivier posed to us is, how do you address that trade-off? And I would say, and I'm saying this in a bit of a stylized way, but I would say that as we are now at the effective lower bound, the balance between that ability to boost activity versus the negative effects on distribution does shift. And I would say that not just going forward, but I'd say that actually even in the short term. I mean, monetary policy was critical in stabilizing financial markets. It was absolutely critical in restoring liquidity, both nationally as well as globally. It was critical in forestalling panic. But I'm not sure, honestly, I mean, it'll take some time for us to have serious empirical work on this. It's very unclear whether monetary policy has, even in this COVID recession, had that much of an effect on activity, as distinct from the massive role of fiscal policy and just government transfers alone. But we do know it's had an impact on asset prices, and with very predictable implications. So I'd say even in the short term, we need to have some circumspection as to what's been happening, but more so in the medium term, because the longer we stay at the current setting of monetary policy, and the longer we have to rely on the asset markets as the route of transmission, the more that this trade-off, which Olivier posed us, will end up on the wrong side. And we do have to be concerned about that. Now, we are able to say this because we do have alternatives in fiscal policy. Monetary policy will have to remain accommodative for a while. I mean, there's no doubt about it. But the heavy lifting is going to have to be done on the fiscal policy side. Heavy lifting to defy secular stagnation, if you're thinking of it medium to long term. I don't see a meaningful, I mean, we just don't know enough now to be able to formulate alternative monetary policies that can somehow address that trade-off differently. We just don't know enough even about the direction of the sign on many of these things. And there's too much ambiguity on the way in which monetary policy impacts on different types of inequalities. So if I take Marcus's point about different types of different spreads or different duration of bonds, and the fact that, yes, there are different groups of investors holding these instruments, that's true, but we are going to find it very difficult to be time consistent. And there's going to be too much uncertainty in monetary policy. So I'd say we just don't know enough at this point. So to my mind, the interesting question then is, in this mix of monetary and fiscal, with monetary remaining accommodative for quite a while, what do we do on the fiscal side? And I'm not going to elaborate on that now, but there is a way of framing this that I think has to force our minds, which is, first, how do we make the best use of a low interest rate, low funding cost environment? It may not be there forever, but it's there for a while to come. How do we make the best use of it for fiscal policy to engage in growth-enhancing investments, to tackle climate change, and to tackle the inequalities of opportunity and the problems of social mobility that are our biggest problems, right?
Yeah.
And second, given that monetary policy is going to remain accommodative for quite a while and is going to continue to have its inefficient transmission, I would say, through the asset markets, what does that imply for fiscal policy and the degree of progressivity that we need in systems of taxes and transfers taken as a whole in order to offset that inevitable impact on inequality, particularly wealth inequality? And this may not be simply a matter of wealth taxes, although it probably does involve some form of wealth taxes. But we really have to think in terms of the overall progressivity of fiscal policy, which is now given greater import because monetary policy will have to be what it is for quite some time to come. And
Yeah,
finally, I'll
actually,
just say that,
I have a question on that
there's
too.
an
So,
opportunity in the new zeitgeist that's been created by COVID. People no longer look down on public goods. People know that there's some benefit that comes out of public-private collaboration and projects, or even private-private collaboration, which has been a very impressive part of vaccine development. So let's use the zeitgeist to be able to think hard about the types of investment we really need in the future. How do we take advantage of a low cost, low funding cost environment and do the
yeah,
big things? I'll stop there.
yeah.